Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Feb 21, 2020. Hey everybody, I'm Preston Brent. Thanks for tuning in. This week's theme is opposites attract. Well, I took a week off or a little bit of time off for the holiday shortened week this past week, and I'm greeted with a lot of fun and frivolity when I come back. This past week, we saw the Dow down. All the indexes were down. The Dow was down about almost 1.4%. Year to date, it's up just a little bit. The S&P was down about 1.25%. Year to date, it's up a little over 3.3%. Nasdaq was down pretty good this week. It was down 1.6%. Year to date, it's up a pretty good solid 6.7%. And the Russell was down about 50 basis points year to date. It's almost flat, really. And volatility finished up for the week. It rose almost 25%. It closed around 17.8. The VIX did. World markets were off a little bit as expected with some of the issues going on around the markets. And the best performing sector in the U.S. this week was the communication sector. It's only up about 40 basis points. The worst performing, with most of it taking a big hit, was the technology sector. It came in down about 2.67%. And then just looking at the valuations, the trailing 12-month PE is about 25.8, but the forward PE ratio, the forward 12-month, is 19.27, so that's lower by about 24.5%. And I'm looking at the dividend yield for the S&P. It's about 1.79%. The 10-year interest rate's a whopping 1.47. So generally, when you got an annual dividend yield and equities higher than the 10-year interest rate, you get a supportive market just a little bit here. But as I said earlier, opposites do attract. It's kind of our theme this past week. I mean, we've seen a record high prices, even though we finished down early in the week. Equities managed to make, most equities, at least S&P and Nasdaq, managed to make new all-time highs. But we're also seeing highs in corporate bonds, U.S. government treasury bonds. They're up, U.S. dollars up, gold is up. Long-term interest rates are setting new records to the downside. We're seeing all-time lows in the 30-year U.S. bond. So what I'm seeing here is we've got this fear of the coronavirus spreading, but we're seeing risk-off assets like gold and bonds soaring higher. Yet with this additional large amount of stimulus brought forward by China and Japan, with some of the effects there, continued stimulus in Europe, and a very supportive U.S. Fed that continues to support equity. So we've seen equities move higher. We've also seen the U.S. dollar move higher. Now it's in a flight to safety. Generally, you see the dollar and the yen moving higher, but the yen is moving lower because we've seen the potential contagion of the coronavirus across Japan. And then they put that 10% sales tax on in Japan, which is really amazing. So that's really suppressed consumer spending there. So the Japanese markets have not been that favorable. So we've seen the yen come down in Japan, as well as we've seen the euro actually go below 108 this past week. And keep in mind, both the euro and the yen represent about 70% of the value of the dollar index. So when these two are going down, you can pretty well bet the dollar has got nowhere to go but up. And that's what it's done this past week. So we're getting this, investors are both in risky on and off sectors at the same time, basically assuming that global monetary central banks are going to continue to supply the liquidity needed to keep the tide from going out to sea, I guess. So easy money makes it more plausible and kind of counterintuitive to hold assets in both risk on and risk off. Okay. So currently, as I look at it this past holiday shortened week here in the US, by the way, Monday's going to be a holiday for Japan. They need a day off. But currently, the markets are kind of at a crossroads with this coronavirus. I mean, I've been looking at the news and the data. It says China has said that so far it's been about 2,000 people have been unfortunately killed with the virus and about 70,000 cases being reported. But they followed up by saying the new cases that are being reported are slowing. But the problem with that is that the most of the global markets are looking at China and not really trusting a lot of the data coming out there from China and the news agencies, which are controlled by the government. I mean, China's already changed the way they count new cases 3 times in the past 3 or 4 weeks. So markets are getting more skeptical about this openness and truthfulness of the Chinese government. So some of the analysts are saying that if factories remain shut for another 3 or 4 weeks, it's going to jeopardize global markets, supply chains, and so forth, and it'll start to really impact the Q2 in 2020. Already Q1 is being revised down for 2020. But we're seeing that if the virus is contained shortly, then most of the contagion and the economic impact will be felt in Q1, and thus markets are betting pretty much on a V-shaped recovery, where markets get a sharp blow to the kidneys in Q1, and then we get a sharp rise after the virus has been contained. But either way, central banks are committed to maintaining market liquidity. So we've still got a lot of unknown risk in the markets. And what you see on the screen here is an Ichimoku. It's a daily chart. You can see the cloud, this green underneath here, has just been going up and up, higher and higher. So it's kind of been very supportive of the markets as we've moved higher. Now, we had a buy signal in the markets on the daily on the Ichimoku back over here in early October, and then we've just been on a tear since. And you can see here the separation between this red line and the blue line here. And for those of you that are members, you can go into our option masters and get a lot more detail on a training video I've got out there on the Ichimoku and how to use it appropriately. Um, but for those of you that just following along here, as long as the red line's above the blue line, the markets are supportive of a bullish market, and we've got a green cloud below, so that again, it's supportive of a bullish market. You can see these railroad tracks down here, which is where I've got longer term support, somewhere down in the below the 3,300. So it take us down to about 3,250, 3,260 areas, more support. You can see we hit my support element right here around 3220 in early February, late January, and then we've just been on a tear since. Okay, and again, we're in a buy the dip moment. And a lot of people think we are in a buy the dip moment, and if you look at the MACD, there's zero divergences on here, so that does suggest we're still in a buy the dip moment. Okay. Unless we take out that key pivot low right there, and that is a key pivot low sitting around 3220. Unless we take it out, then any move lower is probably going to go into one of these things, and then we're going to move back up. Now, if the virus is not contained and it starts to spread into Q2, factories remain closed longer, airlines stop flying to China more, they extend their fly to date, and all these other things that come into play, then you're going to see this number breached, and we're going to come down for a larger swing lower. Okay. So there's still a lot of unknown out there, but I do believe typically because we had a down day on Thursday and Friday, markets tend to continue the momentum from Friday into Monday. So we're going to Monday. So we're going to see how this thing plays itself out. Now, I like to look at the 240-minute chart because it gives you a good kind of an X-ray view of the daily. It's not so tight like a 2 hour or a 1 hour that you introduce a lot more chop to the market. And if I take this down to a 4 hour chart, you can see here where we came down and hit my target perfectly. This line here drawn by eSignal, it's a common advanced get application in eSignal, which is a combination again in Fibonacci, and it uses a combination of time and price levels and extensions on here, and we hit it perfectly. So now you can see that the red has come below the blue. We've actually moved south of the cloud here like this, so that would be more of a bearish kind of scenario. When you're in the cloud here, it tends to be more chop. Notice I've also got drawn on here Fibonacci extensions. Now, these extensions were drawn from the lows made in the fourth quarter of 2018, December 24th, to be exact, when we hit the lows in the markets, and then the highs made in the summer of 2019. So this, or the highs made in the prior pivot high made in the summer of 2018. So this gives us a pretty good feel for where the market's going to be dancing around this cloud here, around 1.618 extension. And you can see here where it held us up for quite some time. Remember, this is a 240 minutes, so it takes about 3 bars to make a couple of days, but it really shows you how this thing really is playing itself out. And we literally sat on this extension right here. If I take it into, let's say, a 15-minute chart, just to even take it down more, you can see here how the markets were dancing around, and just it spent, from about in the entire afternoon on Friday trying to break out of this extension here, and then we managed to just pick back up and hold it right here. You can see the red cloud here, briefly green, but it flipped back to red again. So this does mean that we could run up here and then roll back over again. And if you look at the daily chart, or let's go back to the 240-minute chart here. Looking at the 240-minute chart, and if for those of you that are in the Elliott wave count, Advanced Get does it, Elliott wave count, and it will recount and repaint these based on the best approximation from an Elliott wave. I haven't seen that many indicators that can do this like this can in Advanced Get, which is an indicator that is built into the e-signal application, although you have to pay for it. You can see here that it's painting an Elliott wave 5 that could go as low as the 3250 area, okay, which would take us right down to around my railroad track area, which is just north of the 1.5 fib extension. So if it looks like, and the news appears to be that we're going to get an extension of this coronavirus, we could be down here very quickly, guys. It won't take more than a week or two to get down here. In fact, I don't think it'll be too aggressive, but you just never know. So you need to set your trades up accordingly. We've got some trades in our platform for our secret trader for our members that should hold up fairly well. And I've got a couple of trades that do fairly well in a bearish market also. So if you're not a member, I highly encourage you to come in, because we're at this precipice here where this could hold and we could just wash away some of this scenario here over time, or it could just break south, and you've got to be prepared for both. If we look at the RSI, you can see on the RSI on this 240-minute how we've just been making a series of lower lows until it finally broke right here. You can see that gap right there. We filled the gap, we came back up, and then we just took it right back out again. All right, we took out that key low there, which comes all the way back over here like this, and now we're sitting right on that level there, and the RSI has kind of worked off some of this. And if we go back to the daily chart, you can see here on the daily, also we had a little bit of a divergence here. It showed here, not on the MACD, but it showed a little bit of a divergence here from this high point to this high point here. So we're still, the RSI is still above the 50 level, but it's gonna need a little bit of time to work this thing out. Okay, so that's kind of what I'm looking at right here on this. Now, if we come over, let me just switch it over to another screen here. Let me just get it over to a bar chart for you guys. Let's see, that would be this screen here, screen number 5. So if we come over here and look at this, you can also see I've got on the screen, it's going to take a second or so to paint on your screen there. But if you take a look at this chart here, you'll see I've got the 2020 high, low, and then for all practical purposes, the closing price of 2019. So anything below that line is in the red for the year. So that is also going to be a psychological barrier for us should we get down that low. You can see the trajectory of the red line, which is the 50 EMA, and then the 200 EMA is all the way down here at 3050. So we've got some solid support above us. I don't think we're going to come down and see the 200 EMA. There is no divergence here, so that would suggest that, perhaps the 50 EMA could catch us. You can see this yellow line here, which is where the most volume took place at that price level of 3280, 3262. Okay, and our fib node extensions at 3261, which is 1.58%. It's not on this chart, but that would be a natural place to just gather momentum and find a little bit of a pause button. Okay, so I do believe that the odds do favor a little bit more of a downdraft here, although we could get a respite and a move higher to kind of trick people and then a roll back over again. Now, all of that can go to the wayside if they come out and they announce that the virus has been contained, or they're seeing less cases reported and they've got good containment in Japan, and it's starting to show up in other countries as well. But this is all about the virus right now. Okay. By the way, Q4 earnings are coming in. We still got some more earnings, but we're winding down the week. And right now, earnings are coming in a little bit better than expected, even though the bar is very low. So that'll help set up Q1 earnings in 2020, although the bar has now been dramatically reduced in certain sectors because of the coronavirus. Already they've shaved least a point and a half off the GDP for China for Q1. But that's expected. So keep in mind that's the expectation. So if it hits or comes in better, you'll see the markets move even stronger. So that's kind of what I'm looking at here on the E-minis. Okay, if we look at the Russell, which is bringing up the rear, you'll see here. Let me just put the Russell futures on the screen here. Here we go, right here. If you look at the Russell futures, you can see here we actually on Friday moved into the red for the year and then just gradually closed just slightly north of that big candle right there. Okay, so the Russell has not been playing ball very well, and one of the reasons why is the Russell is also made up of a lot of financial stocks, banking stocks, and when banks or when interest rates start getting very low, the yield curve comes down a little bit, then banks just do not like that at all. And you can see this 2019 close for the Russell, all these tails down here. It seems like as soon as it comes down, algos fire off and push it back into the green again for the year. So we've got to resolve this area here. If we break and go back down here, it could be a pretty fast run down to the 2020 lows for the Russell. Now, the strongest index, of course, is Nasdaq. And the Nasdaq 100, which is, comprised of the largest companies and a lot of the FANGs, and it took the brunt of the action on Friday to the downside. It's still up dramatically. You can see the 2019 close. We're well north of that. You can see the splayed action of the 50 EMA and the 200 EMA. I do believe, and if we pull back to where a lot of the volume took place in Nasdaq, right around 9,100, that's about 355 points south of where we are now. And remember, we took out half that number on Friday alone. It came down almost 170 points. So just a couple of days, and we're there at that pace. I would see, and then we would find support at the 50 EMA. I don't see much more of a dip than that, guys, at least for now. But you've got to be hedged. You've got to be taking profits a lot faster than normal. And of course, if we look at volatility, the first thing I want to show you is the front month vol skew. This is the VIX less uh, the front month vol futures, which is the H20 contract, which is March. You can see we're just barely in the red. It closed just barely in the red here. So that means we're in a backwardation mode, but for all practical purposes, almost flat. We were in more of a backwardation mode during the day, and then as the markets kind of wound their way up just a little bit, where or volatility wound its way back down a little bit, then that kind of put us right at flat. And if we look at the back month skew, that would be March and April. You can see here that we're, even though we move close to the red, we're still in a contango. So right now, the volatility markets are telling us that this is a near-term issue. It's not a further out in time. As I told you before, the markets are betting on this kind of V-shaped recovery where markets kind of get the blow to the gut in Q1 and then they have a sharp rise after the virus has been contained. If the virus is not contained, though, and it's kind of a binary event, it's going to roll back over. So you guys have to be careful with these. And then, of course, if we look at the VIX, you'll see we're in the yellow zone here, right? Yellow zone way up in this area here. We actually, we did not move up where we were at the end of January. The end of January saw us move up to 1997, and then we just dropped off pretty quick. You can see this candlestick here, almost like a little spinning top, or which would suggest it's going to come back down. It's very hard for vol to hold these levels unless we continue to move lower. So we're going to get some action on early next week to see how this thing plays itself out. We could see a pickup in momentum on Monday and then a move higher, but it's really a lot of it's going to be on the news with the coronavirus. Okay. And once we're in the yellow zone, certain option strategies work better than option strategies in the green zone. Obviously, if we move into the pink and then into the red where vol is over 31, it doesn't stay up in these areas long. But once you get up there, there are certain strategies, option strategies that you just got to jump onto. Okay. Now, of course, if we look at treasuries, let's look at bonds first. Bonds moved up a full handle. We actually took out the highs that we made way back over here back in October of last year. Now, back at this level right here, the 2019 high, if you guys remember, at least for our members, I didn't tell you guys, but I was having our members shorting bonds up in this area or buying puts in TLT. and we just rode the thing down. It was a nice trade. But now, if you look, we broke this regression channel. Now we're coming back up here again, and I think it's going to set itself up for another downdraft here. If we get the coronavirus contained, equity markets start moving higher, you see money come out of bonds, and you'll see interest rates start to move a little bit higher and give us a little bit more leeway here. Okay, we're setting up for a divergence, but I don't know just yet. But it could set us up for a nice little trade back down to the 160, 161 area. And if we look at the 10-year interest rates, check this out, guys. It is really very low. I mean, we're near the 2019 lows. The 2018 lows, we're at the 2020 lows, obviously, but we're coming down to the 2019 lows right here, which is 142. And you could just see this level here. I mean, it was just really, we're coming down. There is no divergences here. So that does suggest that we've got some more downside to go. And if we come down to these areas down here, I promise you the equities will not like it. Banks are going to suffer. The rut is going to suffer. And you're going to see the bonds go up a lot higher, and you're going to see the equities, the S&P, give up at least another 100, 200 points if we come down here. Okay, and it'll get to that level that I showed you on the earlier screen. So this is what we got to watch very carefully. Okay, currency wise, look at the dollar, guys. The dollar is just, now it came down hard on Friday, but it's more of a counter trend move. Okay, we're up near the upper boundary of this regression channel. All right, now this regression channel really, I have to step it out here. The regression channel really started in the summer of 2018. And the dollar's done nothing but make higher highs, higher lows as we've moved up. And you can see I'll put some of these little mini cycles in here where the dollar started going down back in September of 2019. But then we broke it and we just resumed this original trend here. I do believe that the dollar having made new, and that should be a 2020 high, not a 2019 high. But I do believe we'll probably move back down into the center down here, but we're going to hold this as long as the yen and the euro stay very weak. And if we look at the euro, it's really low. I mean, you can see we just came right down here. We just overextended the regression channel. We're going to move back up here into this zone right here. There is no divergences here. So with a weak euro and a weak yen, and I'll show you the yen here, because the yen used to be a flight to safety kind of currency. But look at the yen, guys. I mean, it's given it up. It's over the past 3 or 4 days with the coronavirus. Now, I do believe the yen, again, it's been moving down. I think it's going to settle in here a little bit, but there is no divergences that suggest the yen would go higher. Okay. So this is going to keep an underlying bid in the US dollar, moving forward. And then let's look at metals. Look at gold. Gold had a strong Friday. Moved right into my target, both time and price. My target was about 1640, and if I just move this up to reflect a new high in gold, it was 1652. So it came right up through that level there. And keep in mind, as long as interest rates are very low, then money will go into this dumb metal because it pays no dividends and no interest. It's more of a fear. And as long as you've got no inflation and low interest rates, then it's a great place to park money near term. Okay. And that's kind of what we've seen here. And then we had this move here, and then we've had the, a move a little bit higher as we've moved up. So it had a little bit of what looked like a cup and handle kind of pattern, a little bit of a modified pattern. And as I told you guys a couple of Sundays ago, this could be, a 10% move from this 1566 area, roughly, right? So if you just take 1566 times 1.1, it puts you up a little over 1700, right? So it could take us right up to this area right here. Not a straight shot like we've had over the past week. I mean, we've just blown through this with the coronavirus. I can tell you that once they solve this or contain the case and interest rates start coming up, gold's going to come back down into this area here. So if you've got profits in gold, set some tight stops, okay? Although I think it can go higher. And look at our buddy palladium. Palladium has been through the roof too. I mean, look at this thing. Palladium's up here. It closed Friday at 26 or 26.14, and it doesn't look like it's going to give us a divergence here either. If it's holding these levels here, it may even move up a little bit higher. I wanted to short it. I wanted to look for an area here where I could short. Now keep in mind, palladium's an expensive contract. It's $100 a point, and it has no options. So that means most longs or shorts are weak hands. they're out quick because you can't hedge a counter move with an opposing trade in the options market. So that just basically means that there's a lot of speculative players here, but there's a lot of big money in here, sovereign funds that are holding this, like Russia and South Africa, where they make a lot of the palladium. So let's see. I think if it gets up a lot higher, then palladium is used for catalytic converters in the automobile sector. Although, and you would say, well, gee, with the coronavirus, there's auto sales have gone down dramatically, especially in China. You would think this would come down, but this is just for whatever reason, it's moved it higher. So there's an imbalance here in the palladium market, which to me means it's susceptible to the down move. The last time that we had a sell signal on this, a couple of our members made about 24, 25 grand in a few days. A really nice trade. I'm looking for that signal again. We don't have it just yet, but it could be real interesting on the play here. And look at copper. Copper is, I mean, just fell off the table when the coronavirus in China started coming down. And this could be like a bull trap where we move up, we come right back down again. Not really sure yet, but it's going to run sideways until we get a view on where the coronavirus wants to go. Okay. If it's contained, you're going to see copper move back higher. Now, our trade was not in copper, it was in Freeport McMoran. As I told you guys and for our members, I had a signal right over here back in October going long Freeport at around $9 a share. Okay. And then it moved up, and I think some members took profits around 13 a share. So it's $4 a share. That's almost a 45% return in a few months. Is a really nice return. So now we've had this move lower right here, and I've got a target now for Freeport McMoran around a little over 14. It's sitting at about 11.94. And it's a cheap enough stock where you could play it with stock, or you could jump in with some options and play a run on this thing. But the big moves already happened. All right. If we get a rollover, then I'll look at it again. But right now, we could see sideways to upside in a contrarian view on that metal right there, that industrial metal. And look at GDX. GDX is just off to the races too. It's gold miners. You can see here, GDX had moved as strong as gold, because you can see that level here. Gold is well above the previous pivot high, but GDX is not. So it could play catch up here. Okay. Now, I had put a projection of GDX up around 34. It closed Friday at 30.65. So another $4 up, but you'd be chasing it. The trigger here on this trade was back over here, back in late December, early January for GDX, as it was for gold. But these are just some trades that I point out to our members as they're making plays in the markets. Let's look at oil. Oil is really interesting. This was another play that I think I even maybe mentioned this to you guys here in our free session, our weekly roundup. I was suggesting a long trade in oil down at this level down here around 49.50 a barrel. It's up around 53 a barrel right now. There were a number of different ways to play it. The safe way would be to play USO and the ETF, or pick up some a call option or two in the oil markets. That way, you've the cost of the trade, the debit trade there. You can't lose any more than the debit. Or you could do a bull call spread in the trade, or you could do a bear put. I like a bull call better in this particular instance, but a bear call would I mean, a bull put would have been also good with a credit spread, because you could come down here below 40, 43, $44 a barrel and set that as your strike for the short. And you could have, quickly been in and out with some nice money on the trade. Right now, I think it's a kind of a sideways move. It could be a bull trap, as you can see here. It's painting an Elliott wave 3, which would suggest a 4, and then a possible 5 back down here to take out this low around 49 and take us down to around 45. But I don't see too much more downside action in oil. Right. I mean, the big move came in January as we moved from 65 down. I mean, these were moves. And I also pointed this out in our chat room to our members. That was the big move. Now we're just getting some dust up moves here over the next 30 days until oil figures out what it wants to do. And look at natural gas. Nat gas has been in this huge, tight regression channel all the way down, and it's still got a lot of shorts in here. You can see it tried to make a bounce higher, and it rolled right back over again, because I don't see any signal here that would suggest you want to be bullish nat gas. There's still a lot of inventory out there. It's been a relatively warm summer, even though you guys in North Carolina got your annual snow. 2 or 4 inches or whatever it is. I'm down here in Florida, so it's 80 degrees down here. I won't know. But for you guys, I'm sure you enjoyed the snow break. But you can see here that for all practical purposes, it's been a relatively warm and mild winter. So that has just increased the inventory levels. So demand is held steady, but the supply is just really kicked up. It's just we're loaded in nat gas. And with a lot of the LNG tankers not afloat right now with the coronavirus and everything, plants shut down and so forth, it's put downward pressure on all these commodities here because inventory levels have been building up because the usage has been a lot lower with shut down factories and so forth. That will go away. It's a temporary transitory type of event, but for the time being, it's really putting a crimp on some of these commodities here. Okay. All right, so that's kind of where we're sitting right now in the major food groups, everybody. If you're not a member, I highly encourage you to come in and check us out. We're doing very well. This year is going to be really interesting. We're going to have some twists and turns. I believe we're going to finish the year higher, but there's going to be some interesting plays across the commodity groups, whether you choose ETFs or stocks that track that commodity or the commodity itself. And I think there's going to be interesting twists and turns in some of the sectors here this year as we move forward in time. Have a great weekend, everybody, and I will see you members. I will see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.